mortgage rate renewal tricks, and a lot more with our good friend and mortgage broker, Dion Begg. Let's jump into the studio. Yes, my friends, here we are with one of my favorite mortgage brokers in all of the land, Mr. Dion Begg. How are you, my man?
Hey, Gary. Doing well, man. How you doing?
I'm doing excellent, excellent. So there's not much going on in the market these days, eh? Pretty quiet.
Dude, every day I wake up, it's a new day, right? Everything
Yeah,
changes overnight, it feels, but it's an exciting time to be alive.
it,
May we
it
live in
always
interesting times.
It always is. There's lots that we're going to cover today. And we promised last week we would talk about mortgage renewals. So we're certainly going to talk about that. We're going to see some interesting or retrieve some interesting information about first-time home buyers and Equifax and how that affects all buyers in a sense. And of course, different ways to manage your debt. How's that sound? So, Dion, we've been talking about first-time home buyers and in the sense that excuse me, are they really buying homes right now? Well, you sent me some data
Great
this
question.
morning. Share with us what you're seeing from Equifax.
Yeah, sure. So first, let's talk about Equifax as a data point, a data source. So all of us over the last couple of months have probably become economists to the point that we weren't really interested in economics previously, but now we have to be because it's impacting our daily lives more so than ever. And those articles and reports are coming from various government agencies with various measurements, and they're measuring different things. And is this CPI measure the same as that CPI measure? What is actually inside that basket of goods that they say they're measuring, and are they moving stuff in and moving stuff out? It's a big controversy right now as to what they're actually measuring: core inflation, top line inflation, and all of that. Now, put all that aside, and now let's look at Equifax. Equifax doesn't care about any of that. All Equifax cares about as a credit reporting agency is figuring out who is taking on debt, at what levels are they taking on debt, are they making their scheduled repayments on time, and are they performing on their loans, right? This is raw data. They have no reason to make the picture look better or worse than it actually is. So in terms of all the data that I get to look at, I would say stuff that comes out of credit reporting agencies are probably some of the purest data that we have. Okay, so let's first set the scene with that. Now, what it reported is that Q2, that is April, May, and June of this year, actually had a significant jump in first-time homebuyer purchases. And not a small jump. We're talking a jump of, as they reported, 59%. So that's a 59% versus Q1. Now, last week, Gary, you and I did speak about seasonality. So surely some of that is attributed to that. But I think also a lot of it comes down to the fact that a lot of people are just now becoming used to the idea that the idea that they're not going back to a 2% interest rate anytime soon, and they can't hold off on their plans to move their life forward any longer. And so they're saying, you know what, an interest rate that starts with a 5 or starts with a 6 may be real for the next little while, but we need to move. We need to start a family. We need to get out of this smaller home and get into a bigger property. We need to stop being tenants and start building equity. And so people have decided that they're going to do that. And Q2 saw that 59% jump, which is pretty tremendous in my mind.
Yeah, it's interesting. I know when and we always talk about this. When I got my first mortgage, it was 7.5%. Of course, the values were, a third of what they were today. But it's the only thing I knew at that moment. Right. And as you just said, yeah, people are becoming, or last week, I remember you saying this specifically last week, we're getting back to normal. Right.
Correct. Yeah.
And I go ahead, jump in.
Yeah, no, it's just that, I think people are like, yeah, this is the normal now. So let us make these adjustments. And this is where these first time homebuyers have looked at the numbers, looked at the monthly payment. Let's be frank. That's the most important thing. Can we manage this monthly payment? Right. And they're making the decision that they can, and they're moving forward. Right now, are things going to potentially improve over the years ahead? I would say so. I would say that as government data still comes out over these next couple of months and things look like, more job losses, a slowdown in spending, as long as all those things happen, then yes, I feel like the next significant move for rates is down rather than up, right? Not saying there's no more ups. There could be more ups, but I think 1% jumps in the upward direction are probably well behind us, right? And even though we can't guarantee that there are no more jumps, I feel like we're reaching a plateau in the economy, and many economists at various banks are saying the same thing, that if there is another increase, it's going to be 0.25 at the next announcement, or nothing. And if it flatlines for a while, then things might get a little bit easier. So these first time home buyers, and I speak with them daily, they're making decisions based on that type of a picture of the future.
Yeah, yeah. And I should mention too, at the end of our call today, and if you want more and in-depth and specific information and educate yourself, Dion has a really, really cool announcement that we're going to make towards the end of this video. So stay tuned for that. So talk to us a little bit about, let's stay on that Equifax topic. And I know
Yeah.
there's some other numbers we can talk about there too as well. But give us that synopsis of why I, as a borrower, not necessarily need, but rely on Equifax data for my borrowing, prowess, if it will.
Yeah, so I mean, of all the things that a bank looks at, and in fact, let me simplify it. I call it the lending triangle. So I want you to imagine a triangle, and at the top of this triangle, we have the word credit. Okay, and the other two corners of the triangle are income and down payment. Okay, so if you're going to buy a property, these three criteria are what I call that income triangle, the borrowing triangle. The credit is, in fact, one of the most important thing in that triangle, and that's because if you can't get past the credit door, a lot of lenders are not interested in how much down payment you have, or how great your income is. Unless you have a decent credit score, they don't really care about anything else. It's almost like you're walking down a hallway. The first door says credit. If you can't open that door, you can't get through the next ones. So in terms of credit, Equifax and TransUnion are the two large credit reporting agencies that we use here in Canada. Some banks use one and some banks use the other. But in terms of your credit utilization and history, a couple of quick rules of thumb. A lot of people think the less they have on their credit report and the fewer credit facilities they have, the better. That is, in my experience, that's totally incorrect. In fact, some of the highest credit scores I've ever seen are from people who have literally pages and pages of credit history, meaning that they might have 10 or 20 credit facilities. And what that shows is a depth of credit. It also means that if, for whatever reason, there's a screw up on one particular component of a credit card, it doesn't hurt 100% of your credit rating. So imagine you had one credit card and you went on holiday and forgot to make a payment. Now 100% of your credit history is hurt, and your score is going to drop dramatically. Whereas if you had multiple credit cards or credit facilities, that only represents a very small part of your credit history. So start building credit early it's an important thing. A lot of immigrants to Canada who've come from countries which don't use credit in the same way pride themselves on the fact that they've never had to take credit. But in Canada, getting a credit card is actually one of the biggest first steps you can take to buying your first home.
Yeah. And credit is, credit cards, and people always overlook this one, cell phone bills, and that is a huge one, right? And anything to do with borrowing money and paying money every month, in a sense. Not to say that we have to borrow, but it creates a track record, a report card. Really, is that's what it is.
You got it. That's a great way to put it. It's a report card. What's your past experience? What's your past behavior around credit and repayment of credit? And in many cases, past behavior is an indication of potential future behavior. And that's how banks make lending decisions. So get your credit cards and look after them. Make sure you pay them on time. A simple trick is to make sure that you have an automatic payment for at least your minimum payment, so that if you do go on that holiday and you do happen to be out of the country and miss that bill, that you don't have to actively remember to do that. In fact, there was a period of time there, Gary, where I had this, I think it was an automatic $100 payment to this credit card company, and they used to send me back checks every year for $300 or $400 every quarter, because if I did remember, which was pretty much all the time, then I wouldn't have to make that minimum. So I actually got refunds from my credit card company, which was great, but it's better to be on the safe side than on the other side.
Yeah, excellent. There's also some perhaps concerning news coming from Equifax, in a sense, and that's speaking of credit, what's happening with some of those credit card or credit payments and so forth? So talk to us a bit about some of that reporting.
Yeah. So again, so the reports on Q2, Equifax came out and did say that there has been an increase in delinquencies on 30 days plus credit facilities, meaning you're usually given 30 days to make good on your payments. Once you get over to day 31, you're effectively delinquent, right? And so what they're seeing is a pretty significant uptick of 26% versus this time last year. So it means 26% increase means that, again, we've talked about this, the intended impact on these interest rate increases is to make household budgets tighter. And while those budgets have been tightened, people have not necessarily already changed their spending habits, right? So once we start to see stuff like this, it means that, okay, yes, the economy is hurting. Yes, we're performing worse than we were last year. And it's funny to say this in the same podcast where we're talking about this jump in first time home buyers buying. But what I want to say around that is the first time home buyers are going into home ownership knowing that their interest rates start with a 5 or a 6% number, right? Whereas the people who are potentially becoming delinquent on these credit card facilities maybe got their mortgages 4 or 5 years ago, are in variable rates, which they've seen jump from, say, 2.5% now up to, say, 6.5%, or they were in a fixed rate that recently renewed this year. And they jumped again from the 2.79 to maybe 6.5. And so these are people who have experienced payment shock. And so they weren't actually financially prepared for this big jump in monthly mortgage payment. And when that happens, Gary, and you probably know this already, there is an order of priority in which people deal with their bills. Okay. What do you think the very first bill people pay every month is?
It's got to be the house, the roof over my head, right?
Correct. So it's shelter. People are always going to pay their mortgage or their rent first, okay? Second to that, they're going to pay for their vehicle. It's their next most important thing that allows them to live their life, so car payments. And then third, a distant third behind that is all the other credit facilities, such as your credit cards and personal loans. So if we're seeing little cracks right now in consumer credit, that is credit cards and personal loans and delinquencies there, it could very well be the canary in the coal mine that we need to watch. What we need to watch is over the next couple of months, are we now going to see an uptick in vehicle loan delinquencies? And if that's the case, then yes, soon after that, then we could expect potential mortgage delinquencies. Now, let me not sort of sensationalize this. We have a very stable economy and we have a very good repayment rate on mortgages. But if this is happening now, there's likely going to be an uptick. It doesn't mean that 50% of the people on your street are going to default on their mortgage, but it may be a significant percentage to the point that we might be able to see people having distressed sales to some level.
Yeah. And I would look at to 50% of the people are most likely not going to default on their mortgage on your street. However, if you look at your street and in the last, we'll call it 3 years, and there has been, we'll just use an easy number like 10. Maybe that's a big number. Maybe in your community, 10 homes have been sold. Maybe 3 to maybe 4, maybe even 5 of those homes will come up for sale because of the higher interest rates and the variable rates and so forth. That would be how I would look at it. We're not going to see a big flash flood of all of those homes coming up for sale or what have you. But that to me is going to be a true tell. We're already seeing some signs of, there's numbers out there, and I don't have them off the top of my head, but new car sales, those numbers are down. Everyone, even myself last year, when my lease came up on my vehicle, it was actually far better for me to buy it out than it was to get into a brand new lease, right?
And I'm happy we brought this topic up because this is a pet peeve of mine, which is the ability of all car manufacturers to produce these amazing ads which convince us that we need to buy vehicles as frequently as we buy cereal. Because I am not joking. You turn on a cable TV channel, you'll see an ad for your favorite cereal followed up by an ad for a car,
That's
right?
so true.
They probably play them that frequently. And they convince us. They have done an amazing job of convincing the North American that they must upgrade their car as frequently as every 2 to 3 years. And I went through the same experience, Gary, just a couple of years ago when my Infinity came up for renewal. I called a friend of mine who happens to own 12 Mr. Lube franchises.
Wow.
And
Yeah.
I said to him, listen, I've got this car. It's up. I could purchase it outright right now, or I could renew into a new lease. What are the things that, again, the great marketing tells you is, oh, if you hold on to an old car, it's going to break down and you're going to be stranded on the side of the road in the middle of a blizzard when you should have just bought a new car and you would have been better off, right? So my friend went on to tell me that, Dion, in Canada, they've measured, and remember who we're talking to here, a guy who owns Mr. Lubes, whose livelihood depends on people keeping cars on the road. He said the measurements are such that uh, vehicles manufactured in North America or on the roads in North America have a lifespan of approximately 29 years. And he said, don't worry, if you need this car to last another 5 years, then buy it outright and you'll be financially better off. And that's exactly what I did. And guess what? It's been totally fine.
Yeah. 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 And I'm actually glad I did as well. It's one of my favorite vehicles. It suits our lifestyle just absolutely perfect and things like that. And the most important piece is it fits within our financial means. You know, we've seen, I think you and I were talking about this maybe a number of videos ago. The new normal is like, you know, almost $1,000 car payment just for one car.
It's crazy. It's absolutely crazy. And what I'll say to anybody who's concerned about, you know, the reliability of a car that may be more than 5 years old, what you need to invest in is you don't need to spend 12 grand a year in car payments. You need to just find a really good mechanic. That's really what it comes down to. It sounds simple, but you know, ask your dad or your grandfather what they did to keep their cars on the road and how long those cars lasted. I
Yeah.
know they don't make things like they used to, but still, 29 years is probably long enough.
Yeah, yeah, fair enough. Exactly. Exactly. Okay, my friend. There are things that we should talk about. Like last week we brought up the topic of renewals and you know, it's just signing on the dotted line. And I gotta be honest, I've done that in the past. And then Dion's like, Gare, did you ask him this? Did you get that? I'm like, oh my gosh, okay, I'm an idiot. There, I called it.
So, and look,
W-
man, again, I can't blame you. We just talked about how the institutions and the marketing companies play on us, right?
yeah, yeah,
And so you're not to blame. You've just been brainwashed.
yeah.
Okay. So let me unbrainwash you.
Excellent.
And so a couple of things that people feel when they get their mortgage renewal, it's like, oh, number one, if I just sign this piece of paper and send it back to the bank, I don't have to worry about all the potential paperwork that comes with arrangement of a mortgage. And I empathize. I totally get it. Who needs more paperwork in their life, right? But the thing is, these are the same people who will drive 15 kilometers across town to save 5% on gas, which will save them $10 on that tank of gas, right? Whereas a little bit, half an hour of paperwork could potentially save them thousands or tens of thousands of dollars on their mortgage. So please just, when you're looking at stuff like this, put it in context, right?
Mm.
If you're the type of person who will jump on a sale of a TV, then you better be the type of person who's willing to spend 30 minutes to get a better interest rate or a better product. Okay, so let's start with that. The next thing is a lot of people feel that maybe their circumstances are not as good as they were. And that is true for a lot of people. I'll give you a perfect example where, let's say, we have a young couple, they were both working and they got their mortgage 5 years ago. Along the way, they had a child and they decided that for their lifestyle, the wife would stay at home and be a homemaker, and the husbands continued off working. So what's happened now is their household income is lower than it was. Okay. What you need to know is that your bank doesn't know any of that. All they know is what they know when you got your original application. Okay. So they're giving you an offer. They're not asking you to prove that you're still working. In fact, just so you know, you have a right of renewal in Canada unless you have had significant defaults on your mortgage, right? A major institution, scheduled banks, must offer you renewal. Okay. But they generally don't have the right and or they don't ask your current financial status. And so It's kind of, I say it's like this, it's kind of like playing poker with your bank, right? If they've given you an offer, okay, and you've got your cards and you know what chips you have on the table, you know your strength financially, you don't necessarily need to show your cards or show all your chips to your bank, okay? If they offered you something, you should go and search in the market for something potentially better, okay? Find a real number and take that back to your bank and say, hey, look, I understand that this rate is available in the market. Is this something that you can match? Now, sometimes they can and sometimes they can't. But if you are a informed borrower, you may be able to shave 10, 20, 30 basis points off their original offer simply by knowing what else is available and naming the institution that it's available from. So that's one thing I'll say to you. The other thing is when it comes to restructuring or reaching your renewal, many of you listening here are going to really see jumps in payment of $800 to $1,500 a month. It's happening right now. And, we're seeing it right now as well. And what we are doing to help those people is we're sometimes going back to the same bank or a different lender, but we are many times restructuring their debt. And there's a simple way to drop that payment from that jump of $1,000 down to maybe a jump of $200. And that may well be taking that car payment you mentioned earlier, Gary, at say $800. If we can consolidate that into a mortgage, amortize it over a longer period of time, then that $800 payment we consistently drop to $100 or $200, saving that household $600 by just that one move. Right.
Mm.
In addition to that, pushing out an amortization, meaning you're renewing at a 25-year and you could go out to a 30-year, that will also save you hundreds of dollars in many cases. And so by restructuring, we can keep you in your home much more comfortably than just signing that dotted line and hoping that you're going to get through the next 2, 3, 5 years unscathed. Now's the time to actually prepare for, cash flow so that you can manage the payments that you have.
Yeah, no, that's good advice. And we always just assume, oh, this has to be the way to use a Mandalorian quote. It is the way. No, ask questions. Push back a little bit. Push back a little bit. There's always opportunity, I think, when things like this come up. One of the things that we should talk about perhaps next week is the understanding of what consolidating some of that debt looks like, and just kind of getting a clearer picture on that, because as you just mentioned there, these perhaps are things that people will do on the 11th hour, and
Mhm.
maybe not like the 4th or the 5th hour. I mean, we've all been there. We've all been there, right? And when you are pushed up against the wall, you have a lack of options. But when it's like the 3rd or the 4th hour, you have more options. Is that right? Yeah.
100%. In fact, in the 12 months prior to a mortgage renewal, we are touching base with our clients every 3 months. Okay, so at the 12, 9, 6, and 3 month mark, we are touching base with our clients to make sure, hey, are you prepared for this? Do you know what your cash flows are? And so that we're not waiting until 1 month before renewal before we make the changes that we need to in terms of structuring and preparing. So again, that's the benefit of working with, I guess, a mortgage brokerage who's not just there on a transactional basis, but there as the lifetime value that we provide to you is super important, so that you can stay on top of your finances and don't fall into those, missed credit repayments that we're talking about for other people right now.
Yeah. And even I'll look at my own situation, my personal residence. My mortgage is up for renewal in approximately 17 or 18 months. And of course, my wife and I are already having these conversations, because we're gonna double, maybe even triple our interest payment. And fortunately, at the time for us, we took a fixed payment, so we're feeling pretty good right now. But we don't like where this is gonna go, and that's the reality of it. But these are the conversations. Should we be selling off some assets? Should we be planning accordingly so we can perhaps pay down that principal mortgage, in a sense, when that new interest rate comes up? These are all conversations to be having now, right?
Yeah, man. And if you've got a 17-month runway, then you've got enough runway to make measured decisions as opposed to urgent impulse decisions. And yeah, this is the time to plan. And especially as a self-employed individual, you'll understand this too. A lot of our clients who are filing their taxes now a lot of our self-employed clients were actually working together with their accountants, deciding what kind of I guess an income number to put forward. Because being self-employed, many people have the ability to write off, say, $50,000 a year or $70,000 a year in expenses, and they have the legal right to do so. But does that extra $20,000 benefit them on the income side of things, on the income tax side of things? For sure. But does that loss of that 20 grand in income hurt them on the mortgage qualifying side of things? And we sometimes sort of weigh and balance. The fact that you can write off that expense doesn't mean you should necessarily do that. And we measure the saving in income tax versus the saving in interest payment because they qualify for a better mortgage maybe. And those are the big decisions that you need to make well in advance of the 1 month before your renewal.
Yeah, exactly. Okay. So I am sure, and we promised this, that we had something to announce at the end of our video today. I'm sure there's many people out there with many more questions, and talk to us a little bit about what you've got coming up towards the end of this month here.
For sure. So about every quarter or so, I put on a live webinar. And our next one is next Tuesday, September 26th at 7 p.m. Gary's going to put a link to it in the show notes here. But basically, guys, it'll discuss in a little bit more detail a lot of the stuff that Gary and I discuss on a weekly basis. We'll dive a little deeper. I'll give you some real life examples. You'll see real numbers in a PowerPoint format. But my goal with any of these webinars, and I know this, Gary, people are trading off Netflix versus education on real estate. So it's a very big trade-off, and I get it. So I try to make it as entertaining as well as educational as possible. And fortunately, over the years, I've done this long enough now to know what jokes to say and what jokes not to say. Got myself in trouble before, especially from my wife, but also to try and keep things entertaining to the level that, okay, the 1 hour of trade-off with Netflix was worth it for you. So come on down, check it out. Give me critical reviews. I'm ready for it.
There you have it, my friends. I have been a part of many webinars that Dion has hosted. And if you are seeking more information and you want more strategies on, of course, how to set up for your renewals and so forth, and more importantly, how to set up your mortgage and your finances for a better opportunity. I'll say better opportunity because that's exactly what it is. Tune in, whether you are at any stage of buying, first-time home buyer, or you're downsizing, or you want to help your kids purchase a home. This is an important webinar to be a part of.
Really good point there, Gary, because this webinar is really a big part of this webinar is for first-time home buyers, their parents, and their grandparents. Because as we've discussed earlier, property ownership going forward is going to be a family sport. Okay, you can't play on the playing field by yourself like we used to. And, the consequences of everybody's involvement and the financial impact on everybody is something that we will discuss in great detail at this webinar.
I like it. Real estate is not the individual sport anymore. It's a team sport. I like that analogy. That's exactly what it is. All right, my friends. Dion, remind us how to get a hold of you.
Yeah, kangamortgage.ca is the website. Look us up there and we'd be happy to talk with you about any of your mortgage needs.
Excellent. So, of course, that's Dion Begg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.